Thank you, Ken. My name is Kenton Brown. I'm Vice President of Sente Mortgage. We're a local mortgage bank. And one of the things I would tell you is it's really important to find somebody that you can trust in this arena, simply because there's a lot of people that don't know what they're doing. Now, there's only 3 fundamental places to get a mortgage right now. You can go to the bank that you know already. They're getting a little bit challenged right now because they've got a lot of stuff going on in their pipelines, and so they're a little bit clogged up. And then you have mortgage brokers, which can go shop around, which are really great, but those guys are dwindling. They used to be about 65% of the market, and now they're about 15%. We're a mortgage bank. What that means is we control the situation from A to Z. That's really important when you're out there getting a mortgage. But what I wanted to talk to you about was a little bit about the trends that we're seeing right now in the mortgage marketplace. Number one is mortgage companies did not cause the recession. Does everybody know this? we get to be the fall guy. We're blamed for this sometimes. Like, oh yeah, you subprime guys. No, there were certain people in my business that did some stuff that they shouldn't. But the reality is the homeownership rate in this country went up to all-time highs, over 69%. What that means is a whole bunch of people got a loan that shouldn't have gotten a loan. Now, the credit standards, we went through this whole debacle and all this stuff, but the reality is that back in 2008, there weren't a lot of places for the mortgage markets, so people didn't really know where to go or what to do with it. So fundamentally, what happened is the government stepped in, and for about 2.5 years, they bought about $1.25 trillion in mortgage-backed securities. What does that mean? What that means is they flooded the marketplace with artificial demand. That made rates drop literally into the high 3% range for a 30-year fixed rate. It was amazing. And we were like, whoa, we couldn't believe it. Like every single day, it was like rates are coming down. Well, if we fast forward a little bit, what's happening right now is the Fed just announces quantitative easing. And without getting all technical on this stuff, but the quantitative easing means that the Fed was going to pump a little bit more money into the markets. But what happened is they bought treasuries as opposed to mortgage-backed securities, and rates have actually popped up a little bit. They've gone up about 0.75% in the last 3 months. Now, I did some numbers just to look at this, just to compare it and see what it looks like. What that means, let me frame this a little different way. If you take 188 years of the last 210 years in this country, rates have been at or below 7% in this country. So we had this one period of time where rates went way above that, and of course everybody's got to remember that. That was back, I don't know if you guys remember that, some of you are old enough to remember back in the late 70s, early 80s when rates went way high. I mean, a fixed rate mortgage went all the way to like 17.25%, if anybody can remember that. And but believe it or not, people were buying houses like crazy back then. So that wasn't a big deterrent from that. Now we fast forward, rates are in the mid to high 4s right now. Now when I looked at what happens if rates go up 1%, what does that mean to a payment? On a $200,000 loan, which is a pretty good price range for a loan in Austin, Texas, it's about $126 a month, which is about a 12% increase. It's not the end of the world as we know it, don't get me wrong. But if rates go up 2%, say in the mid-6s, which is kind of where they really should be without government stimulus, that means about a 28% increase in payment. Now, the big question people always ask me, where are rates going? What's going on here? Let me ask you this. If you're young, do you think when you're eligible for Social Security that it's going to be there? Okay, now there's some people who go, oh yeah, if I'm 5 years away, yeah, but I'm 52, and then I'm like, is it going to be around? Is it going to be sustainable? I don't know, but there's a fundamental underlying mechanism here is whenever there's a lot of money pumped into the economy, aka government stimulus, historically throughout history, what happens is this creates inflation. Well, inflation is basically the erosion of the cost of goods and services of what we pay for stuff. Now, you'll go out there and see the price of oil, you're looking at the price of gold, precious metals, you're going, are we in an inflationary deal? Well, I'm noticing when I go to the grocery store, it costs a little bit more. I don't know about you guys. It costs me a little bit more to fill up my tank. So has that translated into everything else? Starting to, maybe a little bit. But inflation is the enemy of low interest rates. So what do you think rates are going to do here in the next year or two? I think they're going up. Now, are they going to go up radically? The jury's out on that. I don't know. But in my opinion, when I start looking at all the factors, we were at the housing forecast thing yesterday, and I heard a couple of economists talking, and what's the landscape here is based on all these factors that Ken was talking about, is there is going to be a limited supply of housing, and the cost of lots are going up. So what do you think? Limited supply, that means prices are going to go up. So if you combine prices going up and interest rates going up, you could potentially pay another 25 to 30% per month on your house. So not to say that everybody needs to go out and get a mortgage right now. And let me just dispel a couple myths on the mortgage market right now. I heard a lady on Good Morning America say so the first claim she made was that the average credit score was 599 in the United States. Hogwash. It's really like 730 something. And then the other thing she said is if you don't have 20% to put down, you can't get a mortgage. I'm like, what? That makes absolutely no sense to me whatsoever. There's actually a program called the USDA, which is a 100% loan. It's in the outlying areas, but you can still get a 100% loan right now with no mortgage insurance. It's pretty interesting. There's the good old-fashioned FHA, Federal Housing Authority, that's been around since the 30s. It's a great first-time homebuyer program, but you don't have to be a first-time homebuyer. It's as little as 3.5% down. Now, what Ken was talking about is recently the credit score requirements went from 620 to 640. That's a minimum middle credit score. So I would tell you that the guidelines had to tighten up a little bit, and where we're starting to see is where it's not an hour-by-hour change, but it could be day-by-day change and maybe week-by-week on what we see on underwriting guidelines. But we're starting to kind of see where things are loosening up a little bit, believe it or not. You know, the media and the newspaper love to tell you how hard it is to get a mortgage and blah, blah, blah. But what I'm here to tell you is that everybody's situation is different. And I take it from the perspective, whenever I consult with clients, is if they're not ready, great. That could be because they're not ready. And not everybody should buy a home. I'm telling you, not everybody should. We've proven this. In America, it ain't 69%. The number is probably somewhere between 60 and 65%. That's where it needs to be. And that's where we're starting to see a little bit of equalization here. So when you start looking at the overall factors with everybody's situation being different, that's when it's really important to consult a professional about your individual situation. Very important. Somebody that will act as a fiduciary. Does everybody know what the word fiduciary means? That means they look out for the best interest of the customer. The guys that you read about in the paper that ripped off everybody at their church and all that stuff with subprime mortgage, or the preacher was a loan officer, you know, for God's sake, you know, come on. But what I'm telling you is that most of those guys have gone. The good thing is we now have very strict licensing requirements, and about 40 to 45% in the last 12 months of loan people in this country have disappeared. Like mainly the really sleazy, scummy people have all gone because they can't make a living anymore. I've been doing this for 27 years. What do you think I think about that? I'm like, woohoo, get out of here, you know? So what I'm telling you is when it gets down to your specific situation, consult with a professional because it's very important. I don't have anything else to say. I wanted to thank Ken for inviting me up here to talk about this. If you guys have any questions, I have some cards here with me. Oh, yes, sir. Go ahead.
Yeah, I'm curious. There's two things. Number one is, do you believe that because all these people came in a couple of years, 3 years back, no money down, and when the economy went down, they had no investment law, they had to pack up their clothes and walk.
Yeah.
The second thing is, do you believe there should be, or should get rid of, no down payment, or there has to be something
Well, fundamentally, I think that someone needs some skin in the game, so to speak. Now, what I do know is it's pretty tough out there right now, and it's hard to save. I don't know about you guys, but it's pretty hard to save a little excess capital. So 10% down is a little stout. For somebody who pays their bills, they have a good job, they've saved up 3.5%, or they got a gift where they can put a little skin in the game, I think they're okay. I'm making an evaluation. There's a lot of people back in the subprime days. I didn't do subprime loans because they were just kind of seedy, to be honest with you, for the most part. Like, people have stuff that happens in their lives, divorce, death, and all that, and they have credit issues. But somebody that can't pay their bills, I've literally looked at thousands of loans. I've closed over $420 million in loans, and I can tell you pretty much on the front, I have very few people that ever let their house go because I pre-underwrite it. So if somebody comes to me and they can't rub two nickels together and they can't pay their bills and their rent was $400 a month and their payment's going to go to $1,500 a month, we got a problem here, I think. Now, back in the olden days when the subprime deal, like, well, that guy down the street told me I could do that. Say, well, whatever they say, I'm advising you not to do that. So there is still some good, some viable 100% financing. A veteran can get a 100% loan. They can literally move in for $1, and it's a great program to take care of our veterans in this country. But it's situational. What I would tell you is you can't across the board say everybody's got to put down 10%. So I think the government programs at FHA are a great program for first-time home buyers, or somebody maybe that's struggling a little bit that can't save up enough down payment, but they're sick of paying rent, and their rents are going to go up. So, like I tell you, everybody's situation is different, so I look at it, and from my perspective, I'm doing a little gut check. You taught me this. That's my father sitting right over there, and he was in the mortgage business for 40, 50 years, I don't know, a long time. So he taught me, if you won't lend them your own money, then don't do the loan. And I said, And I've used that as a standard my entire career, and it makes a lot of sense to me. If there's something weird there, don't do it. Yes, sir.
What else do you think that $8,000 that they gave away to all of those supposedly
Yeah, they weren't poor people; they were first-time home buyers.
yeah, but basically it was to get somebody to pay for it. Now, I mean, that's how it was supposed to go.
It was,
A lot of people got in there that had the money.
yeah.
Took advantage of it. People's going to come back and buy it.
I don't know that it's going to come back and bite them, because the factors, especially in Texas, and that's where the mortgage markets I know, because that's where I work, but we didn't see rapid appreciation rates at 200, 300, 400% over years. We saw about 6% per year. It ain't too sexy. And by the way, you couldn't pull out home equity above 80% of the value of your home. So we're pretty protected in a large respect. We're not seeing a lot of defaults from those people that did that. Like, most of the people that are defaulting are right now in a situation where they might have got themselves into trouble. Some of these guys that came in here and bought 20 houses in Kyle or Cedar Park or whatever, because they went to a seminar on the West Coast that somebody told them negative cash flow is your friend. Like, negative cash flow is not your friend. Sorry. I never bought it, and I'm like, what? That makes no sense to me. How could negative cash flow be your friend? How do you sustain that? Well, a bunch of these guys, that's where some of the foreclosures stuff. Yes, sir.
Interest rates continue to go up, do you think that'll bring prices down at all?
If rates go up, what?
Do you think it'll start to bring prices down?
I think that prices have already bottomed out, and what we're seeing is that, Ken didn't show you a chart, but what the guy was showing, it looks like this, and what we're starting to see is this. There's a little tail at the end of that. Just based on pure supply and demand, it's unlikely that prices will go down in Texas, because we have a lot of people moving here, and there's a lot of job creation. And Texas, frankly, is a very friendly state for business. And I don't, if I'm a betting guy, and I'm not, but if I was, I don't think prices are going down. Now, if you get out into Big Spring, Texas or something, I don't know where Big Spring is, but you may have an issue with there. Yeah, I could buy that. But in where we are right here, it's a perfect storm for a great time. Like, when I look at an overall financial plan, because that's what I work with my customers a lot with, is like, Okay, you can invest in the stock market. You can invest, like, where do I invest my money? I don't know. Well, a good diversified investment could include owning real estate. Ken and I talk about this all the time. If you buy a house, I got a rent house in San Marcos that I'm down to about $36,000 on it. I paid 70 something. It's worth about 120. Rent keeps going up. Woohoo! I'm the landlord. Good deal. And by the same token, I'm going to pay that house off, and I'm going to keep it as a long-term strategy, because if I can bring in $10,000, $12,000 a year before I get out of bed, and I go do that with 3 or 4 houses, because there is kind of a limit right now on 4 houses, then I can supplement my income as I get older. And I look at it combining with other stuff. It's all about cash flow. And so I don't think you're going to get hurt buying any real estate in Central Texas. I'll go on the record saying that, because and I can promise you rates are going to go up. It's a fact, yeah.
Another question is, do you think the building of the houses out on the east end, one of these days, the home builders are going to start building again?
Yeah, home builders are going to start building again.
They stopped, they had 187 houses, and they just stopped and walked away.
Well, and one of the nice things that, and not that they walked away, but the national home builders recognized, like, oh, whoa, we got to pull back here. And what they did is they stopped, and the housing starts went way down really quickly, which was a really good thing in our area here. I have a couple of guys that used to work for me that work for builder mortgage companies. They were closing 50, 60, 70 homes a month over there, and now they're down to about 15 to 20, which is a good, reasonable thing. Anything in excess for me is not healthy. When property values go up, I heard a story in Florida. A guy bought a house, flipped it the next day, and doubled the money. Like, paid $300,000 for a house, sold it for $600,000 the next day. Do you think that's sustainable? No, it's not sustainable. And anytime when you got a get-rich-quick scheme, sorry, that doesn't work. It's get rich slow, and that's when you own investment property. You can pay it off. It's part of your financial strategy. You look at the overall picture of things. And you can invest in equities because they produce pretty good things over long runs, you know, at about 9 or 10% historically, depending on what you're investing. But a diverse portfolio for me includes real estate holdings in that. I had a rent house in Houston. It was worth, I think we paid $95,000, went up to $175 at one point, but the neighborhood started turning a little bit, and I was starting to get a little spooked. Plus, it was built in '69. Then all of a sudden, I need a new this and I need a new that about every other month, and I was like going, money pit. So I dumped it, and otherwise I'd still hold on the house, but I think I sold it for $155,000 or something like that. But I just got rid of it because I didn't think that was a long-term viable option. But so you got to buy smart on this stuff, and that, you know, frankly, and not to give Ken a big kudos here, but you got to have somebody that knows the marketplace, and you got to have somebody that can make a good assessment as to what do you think this is going to do. Nobody has the crystal ball or the magic numbers, don't get me wrong, but there's certain speculation you're going to make. In this area, based on these schools and this kind of stuff, it's likely that you're not going to get hurt on stuff. Real estate ain't get rich quick. It's get rich slow. And I keep saying that over and over, but that's the reality of it. Okay, anybody else have any questions? All right, thank you very much. Appreciate you showing up.